Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know. First, US new home sales surge over 20%, but analysts question the data amid builder price cuts. So we'll discuss why this explosive sales number contradicts on the ground reality and what it means for the Fed's fight against inflation. Second, US retail seasonal hiring plunges to a 16-year low, a major warning sign for holiday spending. We'll explore how this hiring slump could trigger a disinflationary wave and potentially alter the Federal Reserve's interest rate cut timeline. Third, Ford targets subprime buyers for its F-150 truck, a high-stakes gamble to boost sales amid rising delinquency rates. We'll examine how this risky sales strategy reflects industry-wide oversupply and what it signals for Ford's expensive EV transition. The most unexpected news in the finance world today has to be this. New home sales just exploded by more than 20% in a single month, hitting the highest level since January 2022. But this wasn't driven by falling mortgage rates. This massive jump happened in August when the average 30-year fixed rate was still stubbornly high, and that has top analysts questioning if the number is even real. One prominent analyst, Ivy Zelman of Zelman & Associates, called the report's magnitude way too high, noting her own larger survey showed a much smaller 6% increase. The chief economist at the National Association of Home Builders even warned that the data has a large margin of error and needs to be confirmed. The context for this number is crucial. The official new home sales data comes from the US Census Bureau, and it's based on a sample survey, not a complete count. This specific report is notorious for having a massive margin of error, often around plus or minus 15%. That means a reported 20% surge could, in reality, be as low as a 5% increase. These initial numbers are also often revised significantly in the following months. So the experts aren't just being pessimistic, they're pointing out a well-known statistical weakness in this particular indicator. Here's where the situation takes a more complex turn. The official median price for a new home actually rose 1.9% to over $413,000. Yet at the same time, a separate survey shows 39% of builders reported cutting prices in September, the highest percentage in the post-COVID period. So are prices rising or falling? The answer lies in something economists call a composition effect. The median price can go up if the mixed times of homes being sold shifts towards more expensive ones. Think of it this way. If a developer sells more large, luxury homes and fewer smaller entry-level homes in a given month, the median sales price will rise, even if they put a small discount on every single house. This masks the reality that on a like-for-like basis, prices for similar homes are actually coming down. The main catalyst for the surprise, as one chief investment officer put it, had to be the elevated level of home builder incentives. This isn't a simple market recovery. It's a brute force sales push with builders essentially buying down high rates for consumers to close deals. So what's really happening is that builders are creating their own kind of private monetary policy to fight the Fed. They use a tool called a mortgage rate buy-down. The builder pays a lump sum to the lender at closing, and in exchange, the home buyer gets a lower interest rate. For example, when market rates were near 6.75%, major builders like DR, Horton were advertising and closing loans with rates like 4.99 or even 3.99%. This creates a huge gap between the new and existing home markets and shows just how aggressive this push is. The strategy appears to be working for now. The supply of new homes for sale plunged by nearly 18% in just 1 month, from a 9-month supply down to 7.4 months. This happened even as builders were slowing down construction, expecting a much weaker market. This creates a new problem that economists call an inventory whiplash. Just as sales unexpectedly surged, builders were hitting the brakes on new projects. This mismatch between soaring demand and slowing construction is what caused that sharp drop in supply. Ultimately, this isn't a story about a housing market defying gravity. It's a story of a market where official numbers are in direct conflict with industry surveys and where the true cost of a sale is being masked by builder incentives. The boom you see on paper is being paid for behind the scenes. So, what's next? The key is to not take this one report at face value. First, watch for next month's housing report, which will include revisions to this explosive August number. That will tell us if this was a statistical fluke or a real trend. Second, keep an eye on building permits and housing starts. If builders believe this demand is real, we should see them quickly ramp up construction. If they don't, it signals they believe this sales surge is temporary, fueled only by costly incentives that can't last forever. That caution we're seeing from home builders isn't an isolated event. It's echoing in the retail sector as well, where a major warning sign for the holiday shopping season just flashed red. Seasonal hiring is set to crater to its lowest level since the 2009 recession. The report we're talking about from job placement firm Challenger, Gray and Christmas is what economists call a leading indicator. It tracks hiring times, intentions, times based on company announcements, giving us a glimpse into the future before the actual holiday sales numbers come out. The projection: retailers may add under 500,000 positions in the final quarter, a sharp 8% decline from last year. But that's not the whole picture. The real turning point is the silence from the giants. This time last year, major retailers like Target and Macy's had already announced their hiring numbers. This year, nothing. Target, which hired 100,000 seasonal workers last year, now says it's just offering additional hours to its current employees. Now, get this isn't just about cutting costs, it's a strategic shift. Target is using what it calls an on-demand team. These are existing employees who can pick up extra shifts as needed, giving the company flexibility without the cost of hiring and training new people. Retailers are moving toward a model of labour optimization, trying to get more out of the staff they already have. This is a structural change, not just a cyclical downturn. So what's the real end game here? According to one workplace expert, retailers are facing a perfect storm of looming tariffs, lingering inflation, and a strategic pivot to automation and permanent staff instead of seasonal hires. The caution from retailers is also a direct signal that US trade policy is starting to cause what economists call demand destruction. The pain is becoming real. For instance, data from the US International Trade Commission shows a significant year-over-year decline in imports of key consumer goods from China, like electronics and furniture. It shows the trade war isn't just a headline. It's directly impacting Chinese exports and hitting the wallets of American consumers. This hiring slowdown directly reflects a slowing economy, echoing a wider trend that saw non-farm payrolls increase by just 22,000 in August, far short of expectations. However, this may not signal a broad economic collapse. It's more likely pointing to a growing chasm between spending on goods versus spending on services. Recent data shows that while spending on durable goods is falling, spending on services like travel and entertainment remains strong. So the economy isn't uniformly weak. Consumers are just shifting their dollars away from the physical products sold by these retailers. This corporate caution is a direct response to pressure on the consumer. Shoppers are contending with higher prices, stubbornly high interest rates, and record credit card debt. A new report from PwC found that shoppers are planning to spend 5% less on holiday gifts, travel, and entertainment this year, the first notable drop since 2020. So what's the silver lining? This weak hiring foreshadows a highly promotional holiday season. Retailers are sitting on high levels of inventory. With fewer shoppers, they will be forced to offer deep discounts to move all that product. This could trigger a new disinflationary wave in core goods, meaning prices for things like clothes and electronics could actually come down. The larger implication here is that if inflation cools faster than expected, it could give the Federal Reserve a reason to accelerate its timeline for cutting interest rates. The key things to watch will be the consumer price index for core goods and, of course, the level of discounting you see in stores. This will be the true test of consumer strength and will set the tone for the economy heading into the new year. We were just talking about retailers bracing for a consumer slowdown, but over in the auto industry, Ford is taking a fascinatingly different path. They're doubling down with a high-stakes bet on their most important vehicle, the F-150 pickup truck. The automaker is now offering special financing to consumers with subprime credit, specifically those with FICO scores below 620. The term subprime is key here, referring to borrowers with weaker credit histories who are statistically more likely to miss payments. And believe it or not, recent data from the New York Federal Reserve shows that the percentage of subprime auto loans transitioning into serious delinquency has been climbing, with some metrics reaching levels not seen since the 2008 financial crisis. So Ford is intentionally wading into a risk pool that is already showing major signs of stress. To put that in perspective, the average new auto loan rate for a subprime borrower can be as high as 20%. Ford is now offering these buyers lower rates typically reserved for customers with top-tier credit. The move is a direct attempt to boost sales for the company's profit engine after F-150 sales dipped 3.4% in August. Interestingly enough, the F-150 is more than just a popular truck. It's a key indicator of the health of small businesses. It's the workhorse for contractors, plumbers, and electricians. A dip in sales could suggest that these small businesses are cutting back on big investments, which aligns with recent declines in small business optimism indexes. This challenges the narrative of a resilient US economy, suggesting underlying demand from this crucial sector might be softening. So the question is, why is Ford willing to take this gamble? The reality is the F-150 isn't just another vehicle. It's the company's primary profit pillar. Traditional gasoline-powered trucks like the F-150 generate significantly more profit per unit sold than their new electric vehicle counterparts. Ford is depending on these truck profits to fund its incredibly expensive transition into the EV space and to compete with rivals like Tesla. Any threat to F-150 sales directly jeopardizes their entire future strategy. In a statement, Ford Credit said it uses a proprietary scoring model and only finances customers it believes are creditworthy, but the market sees the contrast. While rivals like General Motors and Stellantis are also offering deals, their websites state those offers are for well-qualified buyers. Ford's aggressive move is actually a symptom of a larger industry-wide issue, a vehicle glut. Cox Automotive data shows new vehicle inventory in the US has swelled to nearly 3 million units. This oversupply is putting immense pressure on automakers to move metal off their lots. A surplus of cars is a classic leading indicator of price drops, which could become a significant disinflationary force and give the Fed more reason to consider cutting rates sooner. Ford is intentionally targeting a riskier borrower to move its most crucial product, with some F-150 models costing over $100,000. This decision brings both potential sales benefits and comes with inherent default risks. This situation reveals a deeper vulnerability in the US auto market, affordability. As domestic brands struggle to sell expensive trucks, it highlights a potential opening for lower-cost competitors. Keep an eye on Chinese automaker BYD, which is rapidly expanding in Mexico with plans to build a factory there. If they can leverage trade agreements to bring more affordable EVs into the US market, it could dramatically intensify the pressure on legacy automakers like Ford. It's a move that has Wall Street watching very, very closely.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.